I think we can begin.
Sure. Thank you all for coming in today. First, thank you for coming in. I mean, it's been a very on two things. One is what's happened over the last couple of weeks. You had, I mean, the weather has been very different. So to be also to add to that, this year, as far as fixed income has been a year where this is something that we had anticipated, but also let me just state, popular to contrary perception, we were prepared. We were quite prepared for what was happening this year on the fixed income space. We were ready, and we understood. We as a house have always held the fact that this is a where fixed income, which is a relatively boring idea because it doesn't offer the same kind of volatility as equity. This year, fixed income has been very different. It's been very volatile. So, and as far as the house is concerned, we are still maintaining our same stance, where we are of the belief that uh, fixed income as an should be or should is still an essential part of of asset allocation. So, which a lot of people tend to look the other way around because it's also another cyclical asset. And the thing is, why most people don't make money, don't you have not been very successful in fixed income investing is because the calls are taken at the wrong calls are taken at different points in the cycle. So, and the other thing that also been happening there on the markets, as far as the fixed income markets are concerned, is there's been a lot of policy actions. There's been tremendous amount of policy action that's been happening this year. You might have all seen what's happening in the United States and the developed world, where there have been increasing interest rates, and as a corollary effect in the globe. For example, let's take the example of the United States. What's happening in the United States? The interest rates have actually gone up. So since it's gone up, what's happening is, for most people in the United States, whether you like it or not, they have made money on their largest holding would be their real estate, and that real estate largely has come at very low interest rates. And now at this current rates at where their interest rate cycle is, the probability of them trying to make money from their largest asset class is not going to be easy. So that being said, we will start off the presentation. So as I had, in fact, as I was saying in the beginning, um, what's happened? We've had a lot of changes from this one. In fact, in the last 3 months, there's been tremendous amount of policy action from our central banker. So the central banker, knowing the fact that central banker has been flagging off the fact that there is a lot of there's a lot of that there's a lot of I would say unsecured assets that are there. So and this needs to change. So the lending I would say has been the lack of better words would be that lending there'll be animalistic instincts in lending. So the NBFCs have been very aggressive in lending. That coupled with the fact that the banks now RBI has been advising the banks to reduce their risk weight assets, reduce the weightage. So now RBI had to finally play get in last month and say, boss, enough is enough, and they have now raised the norms on that. So what they've done is what used to be 100% is now what from 125 and now 150%. So which basically means now the banks that have lent to all your NBFCs, okay, primarily banks which have lent to the NBFCs now will have to allocate more capital towards it. So that is one thing that's happened. Next one, sir. So, and the other thing, what this might have slipped the notice of a lot of investors. I think I'm bringing this here is the face value of bonds. Usually, the face value of bonds previously have been at 10 lakhs, so that's been reduced to 1 lakh. So this basically means that now this is to deepen the participation in the market. So because that has happened now, what has happened is what used to be face value of most of the bonds that are available in the market, which is available at 10 lakhs, is now available at a lakh, which means it's far more reachable. So which means somebody wanted to put in a 5 lakhs today can actually 5 lakhs or a 4 lakhs today can actually be investing more comfortably into fixed income. And looking at they can actually take bonds as opposed to looking at fixed deposits as an asset. So this is a very welcome move that's happened. And the next one that I wanted to dwell on is this was the joker in the pack. So what had happened is until last year we had a lot of MLDs, or what's known as the market linked debentures. Okay, so since the market linked debentures that were there, but basically it was a tax arbitrage. We as a house were very clear on this from the beginning, saying that we did not. This is a tax arbitrage which we as a house. In fact, Samyukta will also attest to this. That when we saw a lot of MLDs that came in the market, I mean, it was easy for us to. It was easy for us to tell you can go pick it up. See, the only advantage an MLD had was the difference was a tax arbitrage, and that got closed. Something that we anticipated the last couple of years got closed on the 31st of March. So, which basically means now you are taxed no matter what happens. Your taxation doesn't change. And the other thing that also happened is on fixed income. Was fixed income had, I would say this was a, for the lack of a better word, fixed income had an undue advantage as far as indexation was concerned. So the churn of assets were also largely 3-year linked. So end of 3 years, indexation starts, and so which means the client will just hold it on for 3 years no matter what happened in his run. So that with this year goes out. And the third joker in the pack that was the insurance proceeds. So insurance proceeds, which I think was the favorite tool, ULIPs, which was the favorite tools for most salespeople on the banking side, saying that the proceeds were tax free, now becomes taxable. So which means somebody who said that they had to take ULIPs. ULIPs are no longer as I would say ULIPs don't of the tax. Again, ULIPs had the only advantage that it had tax arbitrage. Even that is gone today. So that was something that happened. So this brings us to what has happened on the indexation. So it's been completely changed. So which means now, if you were to look at the chart, I will were to look at this this slide. This I think becomes quite. This becomes. I mean, it's quite evident. I don't need to explain much on this. So which basically now means that you are taxed no matter what happens. So that things happen. That thing goes now. And so what was in your first zero? What was the asset class which usually had a 0 to 35%, so that they could tweak on the taxation? Now that doesn't apply anymore. So that completely goes out of the window. So, and then the next slide, Sam. So this brings me to the point of tax efficiency, because tax efficiency can be had from provident funds, NPSs, which Samyukta will touch upon later also, tax-free bonds, then arbitrage funds. Very surprisingly, arbitrage funds, something that we didn't anticipate. And the other thing would be through the equity savings funds. So tax efficiency you can have if you are looking at fixed income but are still worried about the taxation. But these 5 avenues is actually a good idea to look at. So I will, Samyukta will take over here. So she is also a fixed income specialist, a resident fixed income specialist, and this is her pet team. So she will now take over on this. Thank you, Sam.
Thank you. So now we look at the second part of our wrapping up the year session. And what we're going to do now is to actually look at the investment scorecard for some of the popular investments in the fixed income or the conservative space. So I think the first favorite has always been post office savings schemes or the government run savings schemes, because these have the highest level of safety and they also have a good reputation in terms of the kind of interest that you can earn. So the POMIS, or the post office monthly income scheme, the returns for this year have been at around 7.4%. And there was some changes in the budget on how much you can allocate, etc. So now that you can do 9 lakhs for an individual account or up to 15 lakhs for a joint account. and there is a monthly payout of this interest, and the interest is taxable. With the PPF, the limitation is still 1.5 lakhs per year, and there is a 15-year lock-in. And the interest that you earn on the PPF is compounded, and the return for this year has been fixed at 7.1%. And then we have a senior citizen savings scheme. So the limit from 15 lakhs was raised to 30 lakhs. So now senior citizens can actually invest 30 lakhs of their savings into this scheme, where they get a quarterly payout, right? And the interest rate on the senior citizen savings scheme is pretty attractive today at 8.2%. Here again, the interest is taxable. Uh, and then a new product which was launched was the Mahila Samman Savings Certificate. This is an investment that was open only to women. And there is a limit of 2 lakhs with a 2-year lock-in. We don't know whether this is an investment that will be available in future years or not. It was launched for 2023 and it may or may not be available in the future. Here also there's a pretty attractive rate of interest at 7.5%, and the interest is taxable in this case. So the only sort of tax-free investment so far is the PPF, because there's no tax on the interest that you earn. You also get some benefit for making the investment, and even your maturity proceeds are not taxed. And finally, we have the National Savings Certificate. So the key advantage here is there's no limit on how much you can save. And the interest rate is about 7.7% with a 5-year lock-in. So clearly, this has been a year for safe investing, because after a long time, we're seeing interest rate on savings scheme cross 7%. And just yesterday, what we noticed in the news was that the share of high interest paying FDs has increased to 80% of the total FD market. So we are seeing money move and institutions move towards offering better returns on safe investments. And that's a massive trend that we need to watch out for, because that could spell opportunity for a conservative investor. And then we're going to come to the NPS. So what I've done is I've taken, so within the NPS, you can actually do your own asset allocation. You can increase or decrease exposure to corporate bonds, government bonds, and equities. But for just the sake of what we're doing now, I've taken only the government security returns. And this is across all schemes, right? So in the last 5 years, the returns from just government securities has been anywhere between 7.8 to 8.7%. That's a really good return, because unlike the other investment options that we were looking at, within the NPS, as long as you're saving up for retirement, you're compounding tax free. You can change your allocation based on the market cycle. There are a lot of amazing advantages of having the NPS as part of your allocation. And you can shift between debt, equity. You can also shift across portfolios. So if you start with, say, Birla, and later you want to move to ICICI, all of this happens in a tax-free manner. And there's no other financial product that gives us this level of flexibility and these kind of tax benefits. Obviously, keeping in mind that the NPS is something that you use to save towards retirement, that is essentially the game changer. If you have a shorter timeline, there are a lot of limitations on how much you can withdraw. But I think for those of us who want to save consistently towards NPS or towards retirement, this is a really good opportunity. And product-wise, unlike the EPF, this is not dependent on whether you're employed in the private sector or not. You can contribute to the NPS regardless of where you're employed, how old you are, and when you want to take your money out. So Niranjan walked us through one of the big, or what he referred to as a joker in the pack with respect to tax changes, which is that we looked at the indexation table where now for debt funds as well as some hybrid funds, they get taxed at your income slab rate. So the industry response towards this was to push certain quasi equity products at investors so that they would essentially get a better tax treatment and possibly a better return also. So what we wanted to do now was to look at how this section actually fared. So if we look at equity savings, which is basically 30% in equity, 35% in arbitrage, and 30% or the remaining you have in fixed income, right? So this is predominantly an equity product because 30% is not a small amount to have in equities. Um, this year, equities have done really well, as all of us are aware of. So the returns from these products have been anywhere between, say, 9 to maybe 13 or 14%. And a large part of it can be attributed to the equity performance, right? So from a sustainable perspective of whether linearly, like year on year, you can repeat this kind of performance, I think we should be cognizant of the fact that it may not happen every single year. And for somebody who's looking at a linear kind of return on their investment, this would not be a suitable product. So coming next to arbitrage, which is basically all of the yellow bars in this picture, the returns from arbitrage have been, say, upwards of somewhere between 7 to 8%, which has been pretty good. Because normally I think your return expectations should anchor between 5.5 to 6%. This year has been fantastic for arbitrage funds. But at the same level, I think low duration has kind of kept pace with arbitrage, meaning there's been maybe a 0.2, 0.3% difference in performance. So it essentially boils down to whether which tax bracket you're actually falling under. Because if you're in the higher tax bracket, then a product like arbitrage would have given you a better post-tax return. But if you're in a lower tax bracket, then of course a product like low duration could have done the same thing for you. So depending on your personal circumstances, either one of these products would have worked out favorably. And then coming to tax-free bonds, which have been a market favorite once this indexation benefit was removed. The only limitation here is that actually tax-free bonds don't come in new issuances. So we've not had a new issue in a very, very long time. And from that trend, we can decipher that it's very unlikely that you're going to see new tax-free bonds come into the market, right? So if we look at actually the return, the idea of not paying tax, is it really worth it or not? So if you're making a a post-tax return of 5.1 to 5.2%, your pre-tax return is somewhere between 7.25 and 7.45%. Now, a lot of the post office savings schemes that we saw were clearly beating these records with the same kind of investment horizon. Today, if you're looking at a bank FD, you're not going to get anything less than 7%. If you look at corporate FDs, you can easily get 7.5% on that side, even with a 1 year deposit. So, does it really make sense to just buy a product because it is tax free? That is something we need to really think through and evaluate based on our tax bracket and what our expected post-tax and pre-tax returns are working out to be. And now I'm going to walk you through our scorecard, which is essentially what we had been positive or negative on through this year and how we fared at the end of the year. So one of the things that we were very, very keen on advocating in terms of investments have been short-term funds because the yields on this product were quite attractive at the start of the year. We also felt that from a rate transmission perspective, the journey is not over. And a lot of the transmission had happened on the shorter end of the curve and not on the longer end of the curve. And given that, it made sense to look at accrual kind of products where you're getting a good yield, you're getting a good return, and there's going to be minimal volatility in the portfolio. So there, our recommendation was overweight. Our judgment has been good. If we look at some of the best performing debt schemes for the year, they will come from the short-term category. We were also very positive on corporate deposits. And like I mentioned, a highly rated corporate deposit can give you 7.5, 7.6% today. Being overweight on this has also been a good call. you do have certain small finance banks and other entities which are competing with this category. So based on your risk appetite and the kind of caveats that are there for your investments, I think this would have been a neutral to a good call to have. We were also very positive on corporate bond funds because compared to government yields, corporate yields had some level of spread, and even in terms of the flexibility of managing a portfolio from the risk perspective, right? When we are buying bonds, we are invested only in one or two entities. But when you have a debt fund, you get an entire basket and that diversifies the risk. And mostly, if we look at corporate bond as a category, SEBI has ensured that it is high quality. You have to maintain at least 80% of assets in high rated AAA corporate bonds. So from an investor perspective, also this is a great product because there's no credit risk. You have that flexibility to move across the yield curve depending on where yields are attractive. And I think if we look at the yields also, it's been 7 to 7.5% in terms of performance. Today, the yields on corporate bond funds are closer to 7.8, 7.9%. So this is a product where we can even look at 2024 being a good opportunity to participate in. We were negative on long duration funds. We felt that because the yield curve has been flat, and this is something that we have talked about repeatedly through the year, that this would not really work out for investors in the way that they were expecting. So a lot of the discussions that we've had with investors at the start of the year were around the fact that, okay, at some point we're going to move from this rate hike cycle into a neutral or a rate cut cycle. And wouldn't it make sense for me to be invested in the longer end of the curve so that when rate cuts happen, I make money on the mark-to-market movement on these bonds? But given the nature of the curve being flat and the fact that the long end rallied last year when there was an announcement for bond index inclusion, and it was only a matter of time before it happened, most of the gains to be made were already taken. So there was nothing new waiting for investors in this space. And the difference between, say, your 10-year and your 1 year also was barely anything. So being on the shorter end of the curve rather than the longer end of the curve actually has worked out better for investors today. So our judgment on this call was actually right. I think where we went wrong was with arbitrage funds because we were neutral. Our expectations were maybe that performance would be, say, somewhere between 5.5 to 6% based on historic trends as well as our expectations on volatility and arbitrage opportunities. However, this category has done exceedingly well this year with returns ranging from 7.5 to 8%. And this was the call that we should have worked a little harder on or revised through the year. The other thing that we were underweight on was essentially target maturity. So in selective cases where it was goal-based, we did advocate for this fund on an open-ended basis. But we felt that if you had 1 or 2 years of bad performance, which was something that we had highlighted to investors at the start of the year, as well as the end of last year, it was going to be difficult to make up for that loss of performance in a passive scheme. So if you want to follow a very passive strategy in fixed income, we kind of need to lock in at the top of the cycle and then wait it out. We can't do it mid-cycle because if you're going to do it mid-cycle, you need some course correction, which a passive product cannot really offer you. So clearly that also shows in the return metrics where you've done under 7% in a year where even your bank FD would have given you 7%, right? So that is the benchmark in terms of if you're making a decision, you would want to do better than that on a risk-adjusted basis. So now I'll walk through part 3, which is about 2024 and how we can think ahead from where we are today. So the first is, I think we need to be ready for a new era of monetary policy. So I've just plotted in where our policy rates have been this year, which is that from the RBI perspective, we've had one rate hike in February. So we went from 6.25 to 6.5%, and we've stayed there for the whole year. So even yesterday's policy announcement was to keep rates at the same level, to keep the policy at withdrawal of accommodation. So none of the central bankers have actually come out with a very positive view on inflation. All of them seem to have some level of wariness, and there is still a lot of focus on inflation management. So we are not yet in the rate cut part of our cycle as far as monetary policy is concerned. We also need to brace for the fact that maybe 2% inflation that the advanced economies have been targeting is just the pipe dream, meaning we can't be sure that 2% is going to be a sustainable level to maintain, because as long as you're having growth and you're having financial stability, even if interest rates and inflation are higher, that's not going to be a priority anymore. 2% was something that we had during the period that followed the great financial crisis of 2008. You also had so much extra money in the form of QE that was there in the markets. You also had a period of very low growth, which was fueled by lower interest rates. Now, if lower interest rates are out of the picture, growth has to be reinvented, and it has to come back from traditional mechanics and not just from cheap borrowing costs. Right. So this is why maybe things are not going to be like how they were in the past. And there could be a period of contraction, which if you listen to any of the global monetary policy commentary, like if we're looking at the Fed's policy, they're quite sure that growth is going to be slow. Right. It's a miracle that job additions as well as unemployment has been under 4% this year, but that could become a serious concern as economies contract and things become harder. So the approach of all central bankers has actually been very much meeting to meeting, meaning from one meeting to the next, what is the data that is coming in? What is the priority? Of course, inflation is one of the trend in the inflation numbers, and we'll go through some charts on this as well. But if you see, the ECB has already shown some level of stress in terms of growth targets, as well as inflation not really fully tapering off. The US seems a little bit more confident, specifically because their employment numbers are much better, right? So these are all some of the factors that are really driving what's happening here. And if we look at, so I have talked about US markets having tight labor conditions, meaning in the sense that they're not dealing with an unemployment problem, which has always been something that has followed tightening of monetary policy conditions. Inflation is still elevated, and to a certain extent, that might be okay. And although the central bank has not communicated that yet, and they are still very focused on that 2% number, we can be mentally prepared for some change in that stance or some softening of that stance in 2024. Contingent, of course, on the fact that growth and other parameters are supporting a higher level of inflation. With Japan, I think inflation has largely been a positive, and there's been some unwinding of past policy that has occurred. But again, how this normalizes, whether this translates into growth, is what is going to drive future policy. The ECB has been fairly transparent in communicating a slowdown. I think you can expect that. And lastly, with India, the only thing that we're seeing from the RBI is that they're positive on growth, they're positive on our macros. Our FX reserves have been really good at $604 billion. We do have a stable rupee. We've not seen too much volatility. Last year was quite volatile for the rupee, but compared to other currencies, we actually held ground. So that shows that even during times of stress, that there is going to be a change in the way the rupee is across in terms of a currency. Over and above this, the only thing that is keeping them up is inflation, because they don't want to take it for granted. Yes, we have made a lot of progress since the highs of 2022, But that doesn't mean there aren't any challenges lying ahead, because a lot of work has gone into bringing inflation down. So on one hand, you do have policy measures where cost of borrowing has gone up, so money supply has reduced. Savings have also increased. But there have been many supply side interventions also from the government that have stabilized food prices, right? And given this year's monsoon, the fact that it was not evenly distributed, that it was slightly delayed, there can be more surprises in the food basket that we should be mentally prepared for. On the energy and the fuel side, I think there have been 2021, 22 was a little bit difficult, but we're okay today, right? So why are we saying that inflation, the worst is not over? I think we were looking at some charts, and I'll broadly walk you through this. So if you look at this line, the dotted line is basically the inflation estimate. And there are two components to estimating inflation. One is actually what has the past inflation rate looked like? And by past, I mean the long term. So on a 10-year average, so when we ask people what their inflation expectations are, they're largely anchored in either what they've experienced over the long term plus what they've experienced in the short term, right? So the short term is like the last 1 quarter, and the long term is probably the average of the last 10 years. So what we're seeing now is, if you pay attention to where the dotted green line is, the dotted green line for 2023, towards the end of 2023 and into 2024, is actually above the solid black line, which tells us that the inflation expectation is higher than the past inflation. So if we were looking at past inflation at 1%, 2%, which is how it has been in the US, and this chart is specifically towards the US, we are clearly above the 2% mark. We're closer to 2.5 to 3%. So if we're heading in that direction, I think we need to be ready for the fact that even if there are no further rate hikes, that higher inflation is part of the normal. And I think the same thing applies for Europe. So in Europe, in fact, the difference is even more pronounced. You're closer to 2.5%. This is the same. So the fundamental component is your historic 10-year rate, and you're giving that an 85% weight in this equation. And the 3-month rate, which is what we've had for the last quarter, is got a weightage of 15%. So even in the ECB for the last year or so, your estimate has been higher than the historic trend rate. And it has taken time for us to get to where we are. So maybe this last mile of going from, say, 3.5% or 4% to 2% is going to take us more time than it did to get from, say, 10% in 2022 to where we are today. So these charts just reiterate what I had said. And I wanted to talk about India being a bright spot in terms of flows, because if we look at this year for debt, it has been positive almost every month with the exception of March, and November being the best month this year. So we're hearing a lot about money going into equity markets, and we're hearing a lot about how people are positive about India's economy and the equity side of things. But let's not forget that the smart money is also going into fixed income. And this is an opportunity where it's easier for us to participate. We have more products to choose from today than we did a few years ago. And there's a lot that we can do with safe investments in today's market environment. So one of the key things or key triggers for this has been bond index inclusion, which is basically given India access to long-term foreign capital, almost to the tune of $23 billion. And this is just the first time that we're going to be included in a global bond index, right? As that happens, there could be a cascading positive ripple effect that opens up more doors and gateways for us. Market depth will also increase with this. and there could be a potential rally in yields. But like I mentioned, a large part of this rally already occurred in the past. So only if we exceed what we have targeted, which is the $23 billion, are you going to see a further sort of rally. This could also result in a potential ratings upgrade because given how our corporate as well as bank balance sheets have been, how our fiscal consolidation path has been on track despite COVID and despite a lot of other things that have come in the way, plus just generally how economic growth is going to look, there is a lot of reasons that would point towards a ratings upgrade. But this takes time and you don't know because it's not entirely in our control, but that is there, right? And if all of these things get ticked off, then ultimately for India, we would end up with a lower cost of borrowing. And when we have a lower cost of borrowing, that essentially means in the long run, you're going to be looking at lower and lower returns from fixed income. So our anchoring of return expectations also would need to change over this time period. And the key thing being that not every year is going to be a year where you can dedicate assets and investments towards fixed income because fixed income also moves in cycles. But we are in one of those years where we can dedicate some investments, where we can look at opportunities and take advantage of what is right before us. So, what should we expect from 2024? I think the first thing is that we should expect more FII flows into debt. We've had a good year in 2023. That could become a better year in 2024. I think we can expect a shaped yield curve that's been flat for most of this year. With transmission kicking in, we've not really had any rate hikes, but we have seen some movement in the long-term end of the yield curve. I think as things become more stable, the yield curve will normalize. And when that happens, our opportunities will change, and it'll be good to have some participation as those changes occur. On the corporate debt side, so if you've been a bond investor, you know that there hasn't really been much of change in terms of like the bond yields. But given the change in the RWA regulation as well as the reduction in face value, I think you are going to see some widening of corporate spreads because access to capital is going to become a little harder in 2024 with a lot of these regulatory changes kicking in. But it's also going to encourage more participation. So both things are positive for investors. Yeah, I think these are the three things to expect. And I'll just go to the last part, which is about how you can get it right. So the secret sauce is essentially, sorry. So let me just give you a flavor of finesse, which is that what is it that we do at iThought? I think we do monthly outlooks. So you can always read our blogs. It's fairly clear what we are positive on, and it's a strong track record of everything that we've recommended. So if you feel that in this webinar we're talking something, but it's easy to say at the end of the year what we got right, what we got wrong, you can go back and look at any of our blogs, and you would be able to notice that we've been consistent in our communication. We've talked about many of the themes that we have talked about today, and we host monthly webinars. We also help investors with product selection because while fixed income is boring, there are also the key sort of limitation in this asset class is that you are limited in your returns, right? You cannot make outsized returns with fixed income. And if you're not going to do that, then what really matters is how you're managing your risks, because that risk adjusted return is what you need to look at. There are a lot of products to choose from, and the marketing is always based on past performance. And with fixed income, because this is a cyclical asset class, you can't look at past performance to make decisions. And that's where we're able to add a lot of value to investors. We also conduct investment reviews. So if you have an outside portfolio and you want to restructure it, especially given that this is a year for fixed income, I think we should be doing reviews and restructuring. So it's worth having a conversation. We also help investors construct their portfolio. So if you want to start investments, forget about reviewing or restructuring. With that, also, we're pretty on the spot. We have built portfolios over a period of years. We do encourage investors when there is an opportunity in fixed income to participate. We also recognize that not every year is going to give you that opportunity. So to make the most of the years that come, that is our key objective. So now we'll just open up for any questions that might come. So if you have any questions, you could drop them in the chat box and we'll be happy to address them.
If I may just add to what Samyukta was saying over the course of this presentation, is that okay, we just have a question in the long term. In long term, fixed income is the best. See, I mean, so if I may just answer this question. See, fixed income is an asset, so it's a part of asset allocation. So it's not that it's going to do better than some other asset, or some other asset is going to trump this asset. So in that way, if you are looking to do a lot more fixed income allocation, you should be looking at you cannot run it like what Samyukta was saying. No? Fixed income has to be done with a forward looking vision and not done in hindsight, because hindsight performance, what has been performed on the hindsight, I mean what did well in hindsight is not guaranteed to work. It definitely doesn't work that way when it goes into the future. So for example, I'll just quote this to you. I mean, if you were to look what had happened in 2020, okay, this is also an outlier, but I will bring this to your notice. What had happened was the RBI went and cut. I mean, everybody cut rates very aggressively. So if you were to see, and all of a sudden, within a short period of time, the low durations, your low short-term funds are done extremely well. I mean, in fact, your banking PSU funds, I think they were the stars of the show. Am I right in saying so, Shangupta? In 2020.
Yeah, that's right. Because basically, if we look at that cycle, right? So I think about 2017, 18 was the time that we were recommending much safer investments in fixed income. We were very careful with product selection at that point, and we were focusing only on high quality investments. And then you had the ILNFS, DHFL, the entire NBFC crisis happen. There was a complete risk off, and that spread across the whole market. And in that situation, the yields went up. So funds like banking and PSU, which essentially have the safest kind of bonds in the portfolio, were the ones that did well from 2018 till 2020. But investors in 2018 were not looking at these kind of products. They were interested in higher risk products. They once the crisis happened, they were not interested in fixed income at all. And so in 2020, they started allocating towards these kind of products and the roll down. So the roll down worked because you were locking into a particular yield at the worst possible time. So to play a passive strategy then made a lot of sense. But then you came into 2020 with really good returns, but not the best time to make that kind of investment. So to answer the question of whether fixed income is the best in the long term, today it's giving you a good opportunity, right? And that is the message that we want to leave all the investors in the room with today, that today you have a good chance to make a good investment, which is safe. And given that that is what is there, if it suits your risk profile, if it suits your financial goals, this is an investment that you should look to make. But is it something that you can hold for 20, 30 years? Maybe, maybe not. But that is why you have a product like NPS, right? Where if you're worried about switching and you want to change, you can do that. Otherwise, treat your entire portfolio as a multi-asset portfolio. In the year when it's good to make fixed income, work on fixed income products. When it's time to shift into some other asset class, we can always do that as well.
And then there's this question where one guest is asking about what about investing in invoice discounting platform. We are not big advocates of the invoice discounting platform because one, it's not risk free. You run the risk of counterparty risk is there. So which basically means uh, you it's something that it looks enticing. I will not say doesn't look enticing, but it is like you're basically selling. It's like you're repackaging. This happened. I'll just give you the analogy. It's like basically you have a set of loans that you repackage and sell it elsewhere. So it is the onus is on you to basically buy those loans and then see if you're going to get the money back. So it can take any time. So while even if there's a guarantee, sometimes it can take a longer period of time for you to get the money back. So which basically means your returns will get lesser. And so I'm not a very big. We are not very big fans of invoice discounting for the simple fact this is the basic reason. So we are a bit sanguine on looking at the idea of invoice discount because it's like repackaging your loans. So it's something the big banks have done and they do on a regular basis. But as retail investors, nobody has the kind of bandwidth to do that. So it doesn't make sense. And then the other question.
Also, yes, Samir. Yeah. Also to add, right, whenever we are looking at a fixed income product, the return tells us a lot about the risk that is there in the product. So if you're earning upwards of 12% on fixed income, you're taking a very large amount of risk with that investment. Very rarely are you going to get a 12% investment opportunity, which is a no-brainer in terms of risk. And if that's what we're doing, then we need to consider other asset classes which may give us the same risk or a lower level of risk with the same kind of return profile.
See, also, if I may just add one more thing to what Samyukta was saying. See, the point of invoice discounting is a business sells a loan, a business sells a receivable that is due to them, which they are not able to receive. They are not able to collect. So basically, you become a collection agent. So that's the point of that is the point of the invoice discounting platform. So we are very sanguine about that. And then Samyukta, you want to take this question on the GSEC?
Yeah. Our long-term view for the GSEC is, see, there are a lot of structural factors which are coming into play, which would reduce your long-term cost of borrowing for the government. So bond index inclusion is just the first thing. Now, when I say long term, this can take 5 years, it can take 10 years before your cost of borrowing actually comes down. It's not going to be an overnight thing, or it's not going to be a trend of 2024 where we go from this, say 7% to like 5%, right? So if we look at the US's cost of borrowing, it has gone from 2% to 5% in a span of 1.5 to 2 years. So that's a cyclical anomaly. It might take us time to get, say, even from 7.5% to come down to 6% is going to take a while. When that happens, the idea of playing this gilt thing, where you have a mark-to-market thing, is because you're focusing on a rate cut cycle. Now, a rate cut cycle happens over a period of 1 or 2 years. If you're looking at it from the perspective of, can I make outsized returns if my GSEC yield is going to go from 7% to 4%? If you have to wait 10 years or 15 years for that to happen, you're not really going to make that great of a return. You might get that same kind of return in some other product. But we need to be aware that in the long run, you are trending downwards because a lot of policy measures and macro measures are pointing towards better fiscal management, better sort of growth prospects, better discipline in repaying loans. And if you have a ratings upgrade, of course, that will sort of give you a boost in bringing the cost of borrowing down, right? So from a long-term perspective, that is our view. In the short term, I don't think you're going to see this happen overnight. I think for 2024, the key thing would be the budget and how money gets allocated, because there's a lot of guidance that comes from how money gets spent, right? Because the things that drive the government yields are essentially how much the government is borrowing, where they're spending money, whether they have stuck to maintaining the fiscal deficit or not. So it will be a little bit too early for us to give some guidelines on how the GSEC will look in 2024. But of course, as and when these events happen, we will be providing investors with an update.
And
So
then,
last question
yes,
is how
please take.
to invest in arbitrage funds. I think you could go with a distributor or directly on your own. Those are the two options. If you'd like someone to help you select arbitrage funds, you can get in touch with our team either through the Milestones to Wealth program or through the iThought MFD team, and they will help you in selecting and scaling up your positions as required.
If I may also add to the arbitrage fund, think, see, also a lot of people again. The reason why we put arbitrage, why arbitrage has done well this year was because equity has done exceptionally well this year for us. So as a result, the arbitrage markets are quite buoyant. That being said, arbitrage funds, again, the returns are not linear. Most people assume that these returns are linear. It doesn't work that way. You might go, there have been historically, there have been a lot of months where if the volume hasn't been too high on the equity market, what happens is you lose. There is a lot of loss in arbitrage. The arbitrage really doesn't happen. So that being said, so that's something that I just thought I should just highlight to the question that is there. The returns are very lumpy. It's not linear.
Do we have any more questions, either from YouTube or here?
No, Sam. That's it.
Thank you, Tarun. Thank you so much. So Sam, you'd like to close?
Yeah, thank you everyone for joining us. I know this is not the hottest of topics, but it is a conversation that we believe is worth having. And we appreciate you taking out the time to interact with us. And we'd be happy to do more such interactions in the coming year.
Thank you so much. Have a wonderful year ahead.